What is liquidity? This is the question that we will be answering in today's video. And this video is part of our course on fundamentals of trading. In the first part of the video, we will explain what liquidity means in stock markets. And in the second part of the video, we will talk about dimensions of liquidity in a more general manner. There are thumbnails in the video description, so you can jump ahead to the part you like. Okay, let's begin with discussing liquidity in the context of stocks. I will first make a distinction between liquid stocks versus illiquid ones. Well, liquid stocks can be easily traded in large volumes and without having a significant impact on the price. If you think about large cap stocks, such as the constituents of S&P 500, they are all liquid stocks, because there are many traders at any given point in time who would like to trade those stocks. And typically, because these are large companies, they have large floats, so they can handle large volume of trading with relatively small impact on the price, unless, of course, there is an information that suggests a change in the price. Illiquid stocks are quite different. They trade thinly, so there's not much trade in volume. And for such stocks, it would be quite a challenge to find buyers or sellers who would be willing to trade large quantities at the quoted prices. A good example can be, for example, some of the penny stocks, right? So these are stocks that are sort of with low prices, that are more speculative, smaller companies, so they tend to be a lot more illiquid compared to, for example, large cap stocks. And I would like to give you a bit more analysis here, really, and I would like you to focus on the graph on the right-hand side, just to explain, the difference between liquid versus illiquid stocks. So let's imagine we have actually an order book for two stocks here. So if you are not familiar with limit order books, we have a separate video on that, so you can check it out. Otherwise, let's focus on the gray bars first. So let's assume that gray bars represent our first stock, A. So these are the quantities, the gray bars represent quantities available at different price levels. So as you can see, the bid-ask spread for stock A is 915 to 918, right? And let's assume there's another stock B, and let's say the order book for B is essentially the sum of gray bars and the blue bars. So for B, I couldn't do it very nicely, but this is a B. So it's blue bars plus the gray bars. So what's the difference between B and A, right? Is B more liquid or A more liquid? And according to our definition, B is a more liquid stock than A. Why? Because at every price level, right, it has more quantity on offer. So which means that there's more depth in the order book for stock B. And look at the bid-ask spread for B. It's much tighter compared to A as well. So both the bid-ask spread and the depth of order book are aspects of liquidity. You might wonder why. For example, bid-ask spread represents a round-trip transaction cost. So for example, if you purchase A immediately at 9.18, because this is for A, this is the lowest ask, okay? So if you purchase at 9.18, if you immediately sell it back, you can only sell it back at the highest bid, which is 9.15. So the cost would be 3 cents. Whereas the same cost for B is only 1 cent. Why? Because you would buy it at 9.17 and sell it at 9.16. So round trip transaction cost is lower for B, which is a measure of liquidity. And also imagine a large market order arriving here for either stock, let's say, 5,000 shares or whatever. So for which stock it would make a bigger impact in the price? And the answer is A, because if you look at B, there is more volume available at each price level. So market orders will take away liquidity from the order book. Again, we have a separate video on market orders and limit orders. You can check that out. But essentially, if a market order for A comes, so let's say it might start taking away this block, and so on. So this is a market sell order. Whereas for B, the same size will actually have a lower impact because the bars are taller, right? So for B, so this one will go first, and then there's also more quantity available here, more quantity available here, and so on, right? So both due to order book depth and bid-ask spread, we say that B is more liquid than A. So let's summarize the discussion and make a contrast between liquid stocks and illiquid ones. In terms of the number of buyers and sellers, liquid stocks will have many, whereas illiquid stocks will only have few. Remember, so for example, the constituents of S&P 500, there are many investors who are willing to trade those stocks at any point in time. And because of that, again, the trading volume will be high for liquid stocks and low for illiquid stocks. Again, if you think about penny stocks or small caps or speculative stocks, there's much less trading volume. And we've just discussed the bid-ask spread, which is an aspect of liquidity. Bid-ask spread is tighter for liquid stocks, whereas it is wider for illiquid stocks, and it represents the round-trip transaction cost. And again, due to order book depth, market orders will have a much smaller price impact on liquid stocks compared to a relatively big price impact in the case of illiquid stocks. Finally, it's common for random shocks to arrive to an order book, meaning that, let's say, perhaps institutional investors want to trade large quantities due to liquidity needs, not due to any information. So in which case, the price would change after the execution of that order, but you would expect it to revert it back because those were just liquidity trades. So for liquid stocks, that reversion would be quite quick, whereas for illiquid stocks, it would be a lot slower. In the second and final part of this video, I would like to talk about the dimensions of liquidity in a more detailed and formal manner. And I would have the discussion using this figure, where we have the price of a stock on the vertical axis and the quantity on the horizontal axis. So let's begin with tightness. So we have price increasing going up. So this is the best bid, the highest bid, and this is the lowest ask. Again, if you are not familiar with bid and ask prices, we've got a separate video on that, which you can check. But essentially, what market makers and dealers try to do is to try to buy low and sell high. But from your perspective, from the investor's perspective, unfortunately, it's the opposite for us. So when we want to buy the stock, we will buy it at the ask price and sell it at the bid price. Which means that the larger this gap, the worse is our loss, right? If we try to quickly turn around our position. So this dimension of liquidity is called tightness, and essentially it is equivalent to the bid-ask spread, right? Because we have the highest bid and the lowest ask. So liquid stocks are tight in the sense that bid-ask spread is tight, right? So for example, if we had a less vertical distance between bid and ask, we would say that the stock in that case is more liquid. The second dimension of liquidity is depth. So this is all about the quantities available at each price level, and of particular importance are, of course, the lowest ask and highest bid. So the more quantity available at that price, the better, because it means that larger market orders can be absorbed without having a price impact. So to give you an example, so if we had another stock which looked a bit like this, so let's say going out further and then up, this stock, let's call this A, would be more liquid than B, because at the same ask price, this has more quantity available before the price starts to increase. Okay. Or if you look at down around the bid price, so for example, if we had a stock like this, so let's call this C, and let's say this is our stock B again. Now C is less liquid than B because there is less on offer at the bid price. And if a larger market order comes, then the price will start falling. And that would widen the bid-ask spread, which we don't want. Right, so that's the depth measure of liquidity. And the final one I would like to talk about is resiliency. So resiliency is all about how quickly a stock recovers from random, uninformative shocks. To understand that, we have to think about why investors trade, right? Typically, we trade for two reasons. We might trade on the basis of information, or we might trade due to our liquidity needs, right? So, for example, we might need to sell our shares because we might have a cash need, right? Now, if we are trading on the basis of information, then the price is expected to move. But liquidity shocks are not really informative, so they shouldn't really affect the market price. What can happen sometimes is that you might get, for example, large institutional investors trading large quantities for their liquidity needs. And then the quantity available at the top of the book, so the lowest ask or the highest bid, may not be enough to absorb those large trades. Of course, these investors would try to sort of break down those trades into smaller chunks, but even so, they would still be large trades relative to what retail investors submit, right? So the price might start moving either up or down, causing the bid-ask spread to widen or even start to shift away, right? Now, if this is caused by a liquidity shock, there's no reason for the price of the security to change because there has been no positive or negative news about the company that should affect this price, right? So we would expect in such a scenario for new limit orders to arrive and restore to the position before the execution of those large market orders, right? And the speed with which this recovery occurs is called resiliency. So after a random shock, if the stock is resilient, then the price will revert faster. But for illiquid stock, it might take a lot longer for the price reversion. And of course, this is a measure of liquidity because ideally we would like to trade at prices close to the true price. So if the price shifts away from the true values because of liquidity shocks, that's not desirable because the next trader would be trading prices far away from the true price. All right, that's all I want to say about the dimensions of liquidity, and we've come to the end of our video as well. I hope you found it useful. If that's the case, please consider giving a like and also subscribing to our channel for more content. And thank you very much for watching this video.